You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is John Rubino, author of several books on the economy, including The Money Bubble, his website, dollarcollapse.com. Welcome to the show, John.
Hey, Jim. Good to talk to you again.
It looks like the mainstream media has been caught by surprise, but we haven't. Monday was described as Black Monday as it came to the markets across the planet. Are we going to see more Black Mondays?
We're going to see more volatility, it looks like. You know, and this was seriously volatile, what we've seen in the last week. We had the worst ever two-day drop in the Dow Jones Industrials in the U.S. So, you know, of all the crises of the past, of all the periods of market turmoil, this was the biggest stock market move in 2 days. And then, the day following those two big down days, we had the biggest turnaround in the history of that index, where stocks were up about 350 points at the peak, and then in the last 15 minutes of trading fell to negative 200. So basically what that means is that we've got a lot of stuff going on out there, and it's hard for investors and traders to figure out what it all means. The epicenter right now is China, of course, which, as you and I have talked about a few times, borrowed absolutely insane amounts of money in response to the 2008-2009 crisis, and then built roads and airports and whole cities, many of which are still empty. They're not generating any kind of cash flow to cover that debt, so they have a debt crisis. And during this period, they also had a stock market bubble where a lot of that money eventually flowed into equities, bid up the price of equities, and now, they've got a combined debt bubble and equities bear market going on, where stocks have really tanked there. And that's the second biggest economy in the world that owns a ton of treasury bonds, and has been buying lots of gold and is the biggest trading power in the world and has single-handedly bid up the prices of most raw materials over the last 5 years. Well, they're reversing all of that out now. So commodities are crashing and they're selling treasury bonds and so basically they're throwing the world into chaos. And that's being reflected in the equities markets around the world, really. China's market is infecting everybody else. So you're seeing the rest of the developing world tank and Europe go way down and the U.S. have the volatility we just talked about. And it's not clear what the end point is, because China's doing all kinds of things to try to manipulate their markets. They're making certain kinds of selling illegal, and they're investigating some of the big players. And at the same time, they're easing reserve requirements on banks and pumping new money into the market and lowering interest rates. So they're basically throwing the kitchen sink, everything including the kitchen sink, at the markets. And there's no real way to know what that does one way or the other, except to say that it will probably be fairly extreme, whatever it is. So that's where the markets are right now. And this is more important than your typical bear market because we are, as a global financial system, more leveraged than ever before. And there's a pretty good case to be made that we couldn't handle a garden variety equities bear market around the world, because there's so much debt in the system that even a small perturbation in normal market functioning would have domino effects everywhere. For instance, I just wrote something about the effect of a bear market in U.S. equities on state and local budgets, and it would be borderline catastrophic in some places in the U.S. because big states and major cities have pension plans that they have grossly underfunded over the years, and they're reaching the point now where they're kind of destabilizing to the states, because if their pension plans are too underfunded, that means their municipal bonds are not investment grade anymore, and their interest rates have to go up, which blows an even bigger hole in their budget, makes it even harder to fund their pension plans going forward, and you get the potential for a death spiral. In Illinois is there already. They're crashing and burning. But a lot of other states, including California, are near the edge of that cliff. And so let equity prices plunge, which happens, it happens every 10 years or so, and the economy always comes through it in pretty decent shape, with the exception of 1929. And you get massive investment losses in these pension plans that are already grossly underfunded, so it creates an even bigger hole for them. And that might be the thing that spreads the crisis from Illinois to a lot of other states. And policymakers know this. They can see the numbers just as well as you and I can. And so they are terrified of what used to be thought of as normal market fluctuations. And so they're willing to do anything to keep a correction from turning into a bear market or something worse than a bear market. So don't be surprised if in the U.S., where they're talking about raising interest rates in September, they walk that back, and then by early 2016, they're actually lowering interest rates and otherwise easing. Because if this kind of instability continues for just a little while longer, it creates systemic risks that these guys cannot stomach. So, maybe things will stabilize today. Markets are up a bit, and maybe we'll go back to quote unquote normal. But if we don't, we have another week next week like this past week, then you will see a huge change in public policy, monetary policy, all around the world, starting in the U.S. and continuing through Europe and Japan, and then it'll be even more extreme in China. And who knows what that brings, because we've already tried all this stuff, and it really hasn't worked. I mean, we're in a crisis after 5 years of really aggressive experimental monetary and fiscal policies. So we'll do more of the same. But then the question will become, will we see an even bigger crisis? Because that's what the last batch of these policies caused. Or will something else happen? And nobody knows. This is completely uncharted territory, which makes it really interesting from a theoretical standpoint and really terrifying from a human life standpoint. How do you live through this with your finances intact? And it's not clear how that works out.
Well, is this a lesson? The more governments try to stabilize the market, the more instability they actually cause?
Yes, absolutely, because markets have to live by instability. Their main function is to be unstable, okay? Because the instability, when there's a boom and a bust, as happens in anything that humans do, we're emotional and we cause volatility just by living our lives. That tells us things. If one sector gets over-leveraged and then has a crisis, like, for instance, subprime housing back in the middle of the previous decade, that tells everybody where the limits are in that kind of activity. And so you need that kind of failure to educate everybody else in the financial system about what does and does not work. You take that away, you eliminate volatility, and the price signaling mechanism of markets breaks down. You paralyze the invisible hand, to use another metaphor, and so markets are no longer markets. So you can't say, oh, we have a free enterprise market-based economy, because you don't anymore. And that's what's happened to the world. We've basically paralyzed markets by eliminating their most important function and replacing it with political expediency. And so that's why we've got bigger crises every few years and more instability and more uncertainty. And a pretty good analogy is what's happening in the western U.S. states. Jim, you might be aware of all these fires that we're having down here. I'm sitting looking out the window right now and seeing like fog. It's like a foggy day, but it's actually smoke from fires.
Well, we had that during the Women's World Cup of Soccer, where you could hardly see across the street.
Yeah, and so the reason for that is that for the past 100 or so years, the U.S. Forest Service, at least, has practiced fire suppression. Now, all these ecosystems that used to be shaped by periodic fires were unable to burn. So in some parts of California, there used to be like 50 trees per acre. Now there are 1,000 trees per acre because we didn't let fires come through and clear out the dead wood and reshape the ecosystem in a sustainable way. Well, now when a fire starts, there's all this underbrush, all this dead wood out there that just burns incredibly hotly, and it's very hard to control, and it spreads like wildfire. You know, we can't stop the fires in the U.S. West now. We don't have enough people and equipment. And so they're just burning out of control in a lot of cases. And that's what's happening in the financial markets now, because we are suppressing the normal instability which shapes that ecosystem in a sustainable way. And so we're getting less and less sustainable activities out there and structures. And so when the final fire comes, you know, when the big one hits, it will burn down a big part of the financial system. And, you know, it could be that it's starting. You know, this is what it'll look like when it starts. Because it'll begin with problems on the periphery somewhere that burn their way through to the core, you know, which is the U.S. and Europe and Japan. So we'll see. You know, like I said, another couple of weeks like this, and the whole world will change.
Well, when you talk about the natural progress of things and fires, our Aboriginal population used to cause fires because they knew it built moose habitat, which meant good hunting. So,
yes.
And now they're allowing that to happen in some places up north.
Yeah. Which is the way it should have been all along. You know, fire is an important part of the ecosystem. You need to let it happen. Or you need, like your ancestors there, you need to use it in a sustainable, wise way to shape an ecosystem that can go on as it is for a long time and be productive, you know? So we're not doing either of those things, especially in the U.S., but generally in the global financial system. So when that fire comes, all bets are off.
Why are governments so insistent these days in trying to interfere with the markets? Are they scared that if the population isn't continually fed growing profits on the stock market, something bad will happen, like riots?
Well, back when this began, it was basically political expediency. You know, you don't want a recession going into an election, and we always have an election coming up. So they actively try to minimize the effects of volatility in the financial markets and in the economy in general. And later, see, that led to an excessive amount of debt being taken on. So by the 1990s, when this really got going, we were so leveraged that they were basically terrified of anything happening because they didn't know whether the financial system could survive. So we had, in the 1990s, Mexico defaulted. We bailed them out, so the big banks who'd lent them money didn't have to suffer. Russia defaulted. We bailed them out, same reason. The Asian contagion, when a bunch of Asian countries had financial crises simultaneously, we bailed them out with lower interest rates and easier money. And then came long-term capital management, a big hedge fund, a single hedge fund that got into trouble and was so leveraged and so big that it would have taken down the global financial system if it was allowed to run its course. So Wall Street and the Fed got together and bailed them out. And it's gone on like this ever since. Crises have been getting bigger and bigger, and we've been throwing more and more newly created currency at it and lowering interest rates further and further towards zero and beyond zero in some cases. And now we've reached the point where, you know, debt is just so outrageously high all around the world that even something like a 20% drop in the S&P 500 is a systemically risky event. In other words, it has the potential to take down a big part of the financial system along with it. And so now the guys in charge feel like their hands are tied. They absolutely cannot let anything happen that's more serious than a 10% drop in stock prices. Anything beyond that, they have to intervene really aggressively. And so that's what you're seeing around the world. You know, China's doing all kinds of things, and the U.S. will do all kinds of things if it comes down to it. You know, if the S&P 500 is down by 20% by the end of September, you will see a new QE program in the U.S. where we just say, okay, listen, we're going to buy back $100 billion of bonds a month from now on until the financial markets stabilize. And so then the question becomes, can they fool us again? Or will the markets see this as an admission of weakness, which is what it is, and react accordingly? And then once that happens, it's going to happen someday. So if it happens this time around, then that's game over for the financial system, because there are no more tools left. You can't push interest rates much below zero. And you can't monetize more than the amount of debt that's being created out there without probably causing extreme instability in the currency markets. So we're just about there. We're at the limits of these policies. And so if the next crisis comes and we only have these tools and these tools don't work, then that's the end. Finally, I think you could make the case that it's going to happen eventually, so it's better just to get it over with. Let the fire burn. Let's burn that forest and let it start over with natural processes that have been in place for thousands or millions of years in the case of forests and thousands of years in the case of financial markets. Let us just allow the markets to operate, and in that way find a level for prices and for financial and economic activity that can be sustained going forward.
We'll have more with John Rubino right after this.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome back. We're speaking with John Rubino, author of several books on the economy, including The Money Bubble. I was told earlier this year, if you're paying attention to markets peaking, you should be going into cash and gold. Was that good advice?
That was terrible advice. Actually, cash is turning out not to be bad in the last few days, but gold has been an extraordinarily bad place to be, and that has surprised a lot of people in the gold bug community, including me. I thought it was cheap at the beginning of this year, and yet it's down a bit from where it entered the year. And silver is down even further. So the explanation for this is that we're having a deflationary scare again. This is a 2008 replay in a lot of ways. Back then, oil prices plunged and all the rest of the raw materials in the world went down in price, and it pulled precious metals down because people were more worried about prices going down than up. They felt like cash was the place to hide out in that kind of a situation. So the dollar got stronger, and just like it is now, and precious metals went down. Well, what happened in 2009 in response to the crisis of 2008 is that all the central banks of the world opened the floodgates, and they started creating huge amounts of new currency and cutting interest rates, and that lit a fire under precious metals, which then had one of the nicest bull markets that market has ever seen. So it seems to me that we're setting up the same conditions for that kind of run that we saw in 2008. But because I was wrong about this year, I thought it would begin earlier, and it hasn't yet. That means that the analogy isn't perfect, and so maybe we would need to wait for an equities bear market to panic the governments of the world into this new policy, and that might be next year. Hard to tell when, but so now I'm nervous about saying, yeah, buy gold and silver. Although personally I am nibbling at a little bit of the mining stocks continuously. But really, it's been a brutal and surprising couple of years in precious metals, and that makes it harder to have a firm opinion about what happens in the short run.
Taking a look at oil, people were laughing at people who had predicted that oil would get into the $30 range sometime this year, and yet there it is. There it is.
That's what happened in 2008. It plunged from $140 West Texas Intermediate crude to in the 30s, and so we've basically done that again. We were at like 110 at the peak this time around, and now we're at 39 or 40 or something like that. So the bottom is out there for oil because it can't go to zero. It's got an industrial use that gives it value, and supply and demand at some point will come back into balance. But it's not clear where that is. You know, we got Iran coming online now after sanctions are being lifted on that country, and they're one of the world's biggest oil producers. So if that new supply hits the market while U.S. frackers and Canadian frackers and oil sands and tar sands producers haven't cut their production commensurately, then we'll see an increase in supply at a time when demand really isn't picking up. So we could see another weak year in the oil market, and that would be very deflationary, and that would be a big problem for a lot of the developing world. So a lot of emerging market stocks and bonds might be at risk, and all of those dollar loans that were taken out. There's something like $9 trillion of dollars that were borrowed by the emerging markets in the last few years. And now all of those loans are underwater, and they'll be further underwater. You know, so you can take any starting point and spin a really scary scenario from there. And continually falling oil prices is one of the big ones. If they go down a lot from here, that starts all kinds of chain reactions, and we don't know where it ends.
Now, I heard when the big crash happened in 1929, if most people had held on to the stocks that they sold in panic, they actually would have broken even a year later and made a big profit 2 years later.
Well, there was a little pop in 1931, and then stocks turned back around and went down further. So they didn't, at least in the U.S. stock market, the Dow Jones Industrials, did not get back to the level of 1929 until 1953. So now at big peaks, it takes a really long time to get back to even. You know, even though dividends help. So I'm talking just price levels there. So you actually, in terms of total return, got back to even a little bit sooner, but still was a really long time. And we've set up the conditions for something like that again, where all these indicators that historically have been kind of generational, you know, price-earnings ratios and margin debt and the ratio of equity market caps to GDP, stuff like that. They all say that we shouldn't expect much in the way of positive returns from equities for a decade, at least.
Well, boy, every stockbroker in town is pretty upset to hear that.
Yeah, I wouldn't want to be a stockbroker in the next few years. I mean, already this week, a lot of stockbrokers don't want to be stockbrokers, right? Because they're fielding calls from terrified people who just want reassurance, and you can't reassure them. I mean, if you're a stockbroker, what do you tell a client when the market just had the biggest two-day drop in history? Because you don't know whether that's the end or whether it's the beginning of something. And it must be incredibly stressful to be managing money for individuals or for institutions. You know, managing money in a volatile time is just very hard. And it hasn't been volatile for the last 5 or 6 years. I think a lot of money managers have been lulled into a false sense of security by experimental monetary policies pushing up asset prices a little bit each year, you know, and not. I don't think we've had a 10% correction before this last one. For what was it, Jim? You probably know this better than me. Something like 6 years. A really long time without a normal correction. And so as a money manager, that's smooth stretch of highway there, you know, that's really nice. And now all of a sudden they've hit some potholes. And the potholes could get much, much bigger from here. So it's going to be a stressful time for mainstream money managers.
Well, everybody was into ETFs, but really in a situation like this, you really have to be aware of individual stocks.
Well, if you're an individual investor, stock picking is hard because you're up against all the pros. You know, there are tens of thousands of professional analysts and money managers out there using good educations and the best tools to look at the same stocks you're looking at. So it's very difficult to come close to matching a market, let alone beating it. If you're a regular guy looking at the Wall Street Journal and watching CNBC or whatever, it's just hard to do. So for individuals in the long, long, long run, just buying and holding a diversified portfolio is the best thing to do. But there are times when going to all cash is the best thing to do. And, 1929 was one of those times. 2008 was another one. And based on the big indicators of equity and bond valuation that are now flashing red, this could be another one.
I'm wondering, in volatile times like this, you might not be better off to go down to the casino and just put it all on red on the roulette wheel and let it ride.
Well, if you're trying to make money, that's probably not a lot worse than just buying blue chip stocks. But there are lots of things you can do that don't require you to be in volatile assets. You can buy a house and live in it, or you can own a lot of cash in the short run. And they'll force down the value of your cash, but not egregiously, not right away. I think precious metals in the long run will hold their price despite the last couple of years. And other kinds of real assets will tend to do okay in this kind of an environment. So you don't have to own financial assets. And after an incredibly long, historically long bull market in financial assets, you probably shouldn't own as many as you owned 5 years ago. You should be lowering the percentage of stocks and bonds in your portfolio as they go up. And that doesn't mean they won't go up further. It just means that you're taking some money off the table, you're putting it in a safer place, and that can never be a bad thing. It can bring some missed opportunities, but you can't lose at least in the intermediate term, by taking a little money off the table and getting more conservative as the stuff you've owned goes up.
John, thanks a lot for chatting with us.
Sure, Jim.
My guest has been John Rubino, author of several books on the economy, including The Money Bubble, his website, dollarcollapse.com. You're listening to HowStreet.com radio. Find us on Twitter at TalkDigitalNet. Check out our popular YouTube channel, Talk Digital Network. Comments about the show can be sent to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.